Assalamualaikum warahmatullah and welcome to my video presentation. In this video presentation, we will be discussing MFRS 137, Provisions, Contingent Liabilities and Contingent Assets. To start the discussion, let us first look at the overview of the main subjects of the standard. For provision, we actually have discussed one example of it in earlier course, which is allowance for doubtful debt. This is when we believe that not all debts will be successfully collected from debtors, some may not be paid, and thus it reduces the probable amount of benefits that will be flowing into the company by means of payment of debts. In other words, some of the debts is expected to be not probable, thus the provisions of future expected loss. And then we have contingent liabilities and contingent assets. These two contingencies have not been discussed before, and the questions that this standard is trying to answer with regard to these two contingencies are: is contingent liability a liability? Is contingent asset an asset? One thing that we must remember is that an item is called either an asset or a liability only when it can be recognized as such. That means only when it fulfills the recognition criteria that is being probable for asset and possible for liability, and the value can be measured reliably. If it cannot fulfill this, we need to see if there is a need for it to be disclosed, or we just simply ignore it. For provision, we already know that it is recognized in the financial statements. But how about these two contingencies? And if they are not recognized, why not? If they are not recognized, should they be disclosed, and what should be disclosed? But of course, we need to first understand what is a provision, what is a contingent liability, and a contingent asset before we could judge whether they fulfill the recognition criteria. Before we talk about definition, it is probably wise if we were to discuss possibilities. Though these possibilities are not really discussed in the standard now, but I remember it was discussed in earlier standards before MFRS, just to give us some ideas on what it means and as guideline on how to understand the standard. So here we have virtually certain as 95% chance of an inflow of benefits or an outflow of resources actually happening. Probable being a high chance or more likely than not, which we can refer it as having perhaps more than 50% chance. Just a note, this standard does use more likely than not to explain probable. However, it also states that the interpretations of probable in this standard as more likely than not does not necessarily apply in other standards. Possible is where the chance is medium or perhaps 50-50, and remote is when the chance is low, or there is a slight chance that an event or flow of benefits or resources is happening. Obviously, we could not put a percentage on situations, but even if the standard put a certain percentage, it still requires judgment. I mean, how can we be very sure that an event is having 49% chance rather than 40% chance, or 51% chance rather than 49% chance? So judgment plays a very important role here, and justification in disclosure always helped. A provision is defined as a liability. So here we already know that a provision can be recognized, thus it must be appearing in the financial statements. The only difference is that this liability has uncertainty, either in terms of its timing, that is when it will happen, or its amount, meaning how much is the exact amount will be. So taking the example of allowance for doubtful debt, we either know that when we ask for the debt when it is due, we will not get the whole amount, but we are unsure of how much less it will be, thus uncertain about the amount. Or we know that we will never get the entire amount of the debt, but when exactly will the debtor declare that he or she could not pay the debt is unknown, either when the debt is due or after an extended time given, thus we are uncertain about the time. Liability, as you already know, is a present obligation of an entity. The obligation must be present now, not in the future, that arise from past events, the settlements of which is expected to result in an outflow. Outflow of what? Of resources embodying economic benefits. Taking the example of debt again, but this time our company is the one that is in debt. Since we do not make cash payment when we purchase a batch of goods for resale delivered to us, for example, we are in debt. And that is the past event. We are in debt now because we did not pay cash when we made the purchase, and the obligation to pay is now present, thus present obligation. To settle it, we need to pay cash. Thus cash is a resource embodying economic benefits in our company, and paying that to our creditor means it is flowing out of our company. From that example, we can understand that past events is referring to not just any events, but events that creates obligation, thus obligating events, which define as events that creates legal obligation or constructive obligation with no realistic alternative, meaning there is no other way to settle it other than resulting in outflow of resources embodying the economic benefits of the entity. A legal obligation is an obligation that derives from a contract through its explicit or implicit terms, legislation, or other operations of law. Basically, it refers to an obligation tied to a contract that is binding by law, obligation tied by legislation and by law. A constructive obligation is an obligation that derives from an entity's actions where the entity has indicated to other parties that it will accept certain responsibilities, and these indications are made through an established pattern of past practice, policies of the company, or a specific statement that is made published, meaning everybody knows about that responsibility of the entity. And as a result, the entity has created a valid expectation on the part of those other parties that the entity will discharge those responsibilities. For example, we often see advertisements by shops that state lowest price guaranteed, and if we can find other places with lower prices, they will refund the difference. Now that difference is something that a customer would expect to be refunded if they actually find another shop with much lower price, meaning to say there is no legal obligation, but there is a constructive obligation, an expectation to bind the shop to make that refund. Or a more common policy of companies where it gives warranty, where it can either be a replacement of a default goods or repair, which both means cost to the company making that policy. With this, it means that having no realistic alternative to settlement other than those resulting in outflow of economic benefits of the entity can only occur where the settlements of the obligation can be enforced by law, or where the event, which may be an action of the entity, creates valid expectations in other parties that the entity will discharge the obligation. Now, a constructive obligation can be transformed into a legal obligation. For example, when a company is facing insolvency, one of its ways to ensure going concern is to restructure itself, and we call that as a restructuring program or scheme or plan, where management will be discussing deals with creditors to perhaps accept a lower repayment, and at the same time discussing with shareholders to perhaps increase capital and absorb some losses. They might also, within the restructuring plan, make redundant some of their employees. So when the plan is communicated to its employees, creditors, and shareholders, that is when the entity has a constructive obligation, everyone involved expected an action taken by the company at the time communicated by the company, say in 5 months' time. But until the time of implementation arrived, it will remain as constructive obligation. When the time comes to implement it and company has no other option but to go on with the plan, that is when the constructive obligation becomes contractual obligation. The company has to, for example, enter into contract with its affected employees to pay certain amounts of compensation, or enters into contract with its creditors to pay certain amounts within certain time frame, and so on. Similar to provision, we understand that it is a liability but a deferred one because of the uncertainty on timing or amount. We can also understand contingent liability from the definitions of liability. But instead of having a present obligation, we now have possible obligation. Remember the level of possibilities? Possible is located in between probable and remote, or having 50-50% chance of it happening. It also arising from past events. Contingent liability can also be present obligation arising from past events. So contingent liability can be both possible obligation and present obligation. For a possible obligation, which we can say that it has 50% chance of existence, it will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. So we can say that until certain event happens in the future, the outflow of resources will never happen, and the important point is this future event that the possible obligation depends on, the entity has no control over it. Thus, it has no power to stop the events from happening or not happening. That is why there is always a possibility of it happening, thus the obligation exists. For present obligation, we know that it should be part of liability. However, in this case, it becomes contingent liability because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. In other words, it does not fulfill the recognition criteria of probable and reliable measurement. Just to complete the concepts discussed in the standard, we also have contingent asset, which is defined as a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity, which is similar with contingent liability. An onerous contract is a contract in which the unavoidable costs of meeting the obligations under the contract exceed the economic benefits expected to be received under it. And the restructuring, as an example given earlier, is a program that is planned and controlled by management and materially changes either the scope of a business undertaken by an entity or the manner in which that business is conducted. In the advanced level, we will be discussing this program in detail, but for now, let us take this program as a program where management is trying to re-strategize its company to remain going concern. In terms of recognition, by now, we already know that provision can be recognized, but just to refresh our memories on this, a provision can only be recognized if it fulfills these criteria. An entity has a present obligation, either legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. And of course, the criteria is similar to a liability, since it is a liability, only that we are not sure in terms of timing or amount. This is different from contingent liability, where it cannot be recognized in the first place, even if the obligation is present, because it does not fulfill the general recognition criteria, or the obligation is just possible instead. If it is not clear whether there is a present obligation, we need to judge if, by end of the reporting period, taking into account of all available evidence, such as expert opinion, it is more likely than not that a present obligation will exist. This is especially true in the case of provisions, which by their nature are more uncertain than most other items in the statements of financial position. Except in extremely rare cases, an entity will be able to determine a range of possible outcomes and can therefore make an estimate of the obligation that is sufficiently reliable to use in recognizing a provision. In the extremely rare case where no reliable estimate can be made, a liability exists that cannot be recognized. That liability is disclosed as a contingent liability. For contingent liability and contingent asset, both shall not be recognized, simply because, as we learned from their definitions, they do not fulfill the recognition criteria. A contingent liability is disclosed as required by paragraph 86, unless the possibility of an outflow of resources is remote. Where an entity is jointly and severally liable for an obligation, the part of the obligation that is expected to be met by other parties is treated as a contingent liability. The entity recognizes a provision for the parts of the obligation for which an outflow of resources is probable. It means, if, for example, my company has a joint and separately liable obligation with another company where the outflow is probable, say for example 50% for my company and 50% for the other company, my company will recognize its portion as provision. But for the other company's portions of obligation, it will also be disclosed as my company's contingent liability, because in the event where the other party could not fulfill its obligation, depending on the contract, my company will have to be responsible for it. Contingent liabilities may also be developed in a later date, meaning it might not, in a way, initially expected. Therefore, they are assessed continually to determine whether an outflow of resources has become probable. If it becomes probable that an outflow of future economic benefits will be required for an item previously dealt with as a contingent liability, a provision is recognized in the financial statements of the period in which the change in probability occurs. For contingent asset, the standard recognizes that contingent assets usually arise from unplanned or other unexpected events that give rise to the possibility of an inflow of economic benefits to the entity. And it gives an example of a claim that an entity is pursuing through the legal process where the outcome is uncertain. It may win and get the claim, thus inflow of economic benefits, or lose and not getting the claim. Consequently, because of its uncertainty, it cannot be recognized. However, whenever the realizations of the inflow or income is virtually certain, then the related asset is not a contingency anymore, and it should be recognized appropriately. For contingent asset, it shall be disclosed if the inflow is probable. In terms of measuring the value of provision, there are a few things that should be taken into account. The amount recognized as a provision shall be the best estimates of the expenditure required to settle the present obligation at the end of the reporting period. The risks and uncertainties that inevitably surround many events and circumstances shall be taken into account in reaching the best estimates of a provision. Where the effects of time value of money is material, the amounts of a provision shall be the present value of the expenditures expected to be required to settle the obligation. The discount rate or rates shall be pre-tax that reflects current market assessments of the time value of money and the risk specific to the liability. The discount rates shall not reflect risk for which future cash flow estimates have been adjusted. Future events that may affect the amount required to settle an obligation shall be reflected in the amounts of a provision where there is sufficient objective evidence that they will occur. Gains from the expected disposal of assets shall not be taken into account in measuring a provision. Gains on the expected disposal of assets are not taken into account in measuring provisions, even if the expected disposal is closely linked to the event giving rise to the provision. Instead, an entity recognizes gains on expected disposals of assets at the time specified by the standard dealing with the assets concerned. From our discussion, we can use this decision tree to decide on whether we should recognize a provision or disclose a contingent liability, or we should just do nothing. Some may find this decision tree helpful, and some may not, but I would rather share it with you, so please bear with me. We start with asking the questions of whether, as a result of a past event, there is a present obligation. If the answer is no, then we ask, do we have possible obligation instead? If the answer is still no, then we do nothing, as there is nothing concerning us that need to be reported. But if we do have possible obligation, the next question to ask is whether probability of the outflow of resources is remote. If the answer is yes, then we do nothing, as there is nothing to be concerned about. But if it is not remote, then it should be disclosed as contingent liability. Now, if the answer to our first question was yes, we do have present obligation, then we need to ask about the probability of the outflow of the economic benefit. Is it probable? If the answer is no, then we ask if it is remote instead, and the decision continue from there, like before. If the answer is yes, there is a probable outflow, then we ask the second recognition criteria question, that is, can we reliably measure the outflow? If the answer is no, which is rare, we cannot recognize it yet, thus disclose it as a contingent liability. And if the answer is yes, we provide for it, meaning we recognize a provision.